SoFi CEO Anthony Noto recently spoke on Tuesday at Citi's Financial Technology Conference, where he dropped a ton of new insights on the company's direction in 2023, what he thinks of the student loan moratorium and whether he thinks that's going to continue or not. And in this video, I'm going to be summarizing some of my key insights from that conference and diving a little bit more in depth on some of the hints that he dropped going forward. I took a look at the entire conference and I basically broke out some interesting segments that I found, and I'll do my best in this video to include clips that talk about all three of their pillars: their lending business, their financial services business, and their technology platform. But there's a ton of stuff that is not included in this highlight reel that he talked about in that conference. So I'll attach the link to the conference in the description below so you can actually access the full thing for free. In this video, again, I'm cherry picking the main things that I found interesting, the main insights that I personally enjoyed. And before we get into it, I just want to have a shameless plug. If you do enjoy these videos on SoFi news, commentary, and analysis, please subscribe to the channel if you're not already subscribed. And if you enjoy this particular video, share that out. It really helps the channel grow. Okay, so first and foremost, I think one of the main things that I found was that he talked about 2023, where SoFi's going, SoFi's diversity in their product offerings, and how this diversity in product offerings basically allows them way more flexibility in terms of being agnostic to the rate environment. They'll succeed whether it's high interest rates or low interest rates because of this product diversity.
The other part of it is just planning for next year. And just from a prudence perspective, are you modifying your planning process as you think of next year?
Yeah, I think we've lived in a world that no one else has lived in since 2020. Yes, everyone's had to navigate working from home in the pandemic and protecting their employees, et cetera. But I think we uniquely got hit with a big external threat in March of 2020 when the president announced appropriately a moratorium on paying federal student loans. And that really hurt our largest and first business in student loan refinancing. We went from generating $2.4 billion of origination volume in the fourth quarter of 2019 when Fed funds was 1.65% to this most recent quarter generating less than $400 million of origination. So it's less than 25%. The reality of that for the last 2.5, 3 years is that we've had to reallocate resources to other growth areas. I think we've proven that we have a pretty diverse business. We built this business to accomplish our mission, which puts the member at the center of what we're building, which is a one-stop shop. The business benefit of that is that we have a lot of businesses that are pretty diverse, and we can play the game of where can we win the most in a certain environment. When rates are low, we can win in things like home loans, and we can win in things like investing because there's no yield on checking and saving. When rates are high, we can win in things like checking and savings. We can win in things like personal loans. And so that diversity has allowed us to overcome the challenge of the last 3 years of student loans being where they're at. It's also forced us to scenario plan. When is the student loan moratorium going to end? I think it's been extended. I've lost count 5 or 6 times, but we've always had a plan B, C, or D to drive the growth. And I think one of the things I'm most proud of as a company is not just that we built something no one else has built, but it's proven to be durable. The fact that we've hit 6 record revenue quarters in a row and 8 quarters of positive EBITDA, despite that, punch in the face, so to speak, from our largest and most successful business, most differentiated business, largest market share business being hit is a testament to what we've actually built. So as we go into 2023, we couldn't be more optimistic about our position in the marketplace and the growth opportunity ahead of us. And whether student loan moratorium gets extended or not, we're going to deliver really strong growth if we're in an economy that's what we expect it to be, which is a little bit more dour than today, but not overly dour.
Now, one of the other factors that Anthony Noto kept referencing whenever he talked about 2023 was the student loan moratorium. You might have even noticed it in that first clip. And we've been discussing this for several videos now, where basically after Biden's announcement that student loans were going to resume in January 2023, there's been numerous pushbacks from different people that have basically introduced more ambiguity into that date leading up to it. And especially it's a little bit a point of tension because back in 2021, when Biden was initially going to resume student loan repayments in 2021, it was only canceled and pushed back like a couple of days before it was supposed to be starting. And this hurt SoFi because SoFi basically had already prepared some marketing materials, had already prepared the commercials, and had already budgeted out what their campaign was going to be for resuming student loan payments. And all of a sudden, end of December, the Biden administration, like 2 days before the student loans were going to resume in 2021, they had an emergency meeting and they extended it again. And now we're at that point where basically history is repeating itself for 2022. And the anxiety that's coming out of this pushback from a judge in Texas or from the 8th Circuit District Court of Appeals, All of that is leading into this anticipation coming into the final weeks of December, whether the administration will basically do a repeat of what happened in 2021 and further extend it into 2023, or whether it's going to resume as scheduled. And one thing is for certain, that this moratorium, or whether this student loans is going to resume in January or not, is front and center in Anthony Noto's mind, because he basically talks about it and references it a lot throughout that conference in several instances when talking about 2023. Here's a clip.
On student loans, last year you saw ahead of the moratorium supposedly ending, there was a lift. Are you expecting that kind of a lift now?
Yeah, every day the environment changes. If the moratorium ends on January 1st, which remains a big if until we get there, we anticipate there will be a lift in December, which is what we saw last year. As I mentioned, we were doing about $2.4 billion in the fourth quarter of 2019. We still think there's a really big TAM with rates up as high as they are now. A couple $100 billion of TAM people would save in student loan refinancing in our credit box today. And so we think we can get back to the high ones, low twos on a normalized basis when payments resume. We also think, and we've seen this in personal loans, that there will be a fair amount of the population that have not refinanced in the past, have been waiting to see if they get forgiveness. They now know if they're getting it or not based on what was announced. The courts are now debating that, whether it was something the president had the authority to do or not. But let's assume for a second he did. People know what they're getting, what will be forgiven. And at most it's $10,000. Most of our members are over the limit of $150,000, so it won't apply to them. Even if they can't save on the interest rate, we think there will be a high propensity of people to term out that loan over a longer time period to lower their monthly expense. They could still pay the full principal amount that we're paying before if they want, but it gives them the option to pay less on a per month basis. The thing that's interesting about the student loan refinancing product is, let's say their rate right now on that is 5%, and they can't get better than 5%, they can get 5.5. It's maybe in their interest to refinance it at a higher rate, term it out over 10 or 15 years, so their monthly payment is low, so they can kind of afford the higher inflation environment that we're in. And a year and a half from now, when rates are come back down, they can refinance without any additional cost. Unlike a mortgage, there's no closing cost, there's no title insurance. It really costs them nothing to refinance the loan. We don't charge fees. So it's almost a frictionless option for them to refinance and lower that cost over time. They could still pay back at the same rate they were before, but have the optionality, if they're short relative to the cost that we're seeing in the environment, they could have more discretionary spending. Regardless of what happens, I think there will be incremental demand. The question is, does it get all the way back to about $2 billion a quarter? And I think if it resumes in January, it does. If it doesn't, it's somewhere in between.
Now, aside from student loans, some of the other factors that he mentioned were SoFi's bank charter, which, we've been seeing a full year now with the bank charter since they got it in January of 2022, and how that contributes to SoFi's moat in general. When talking about the bank charter, he mentioned some of the incremental improvements in direct deposit customers, and he also explained why this was a big deal, and he discussed how this growth in direct deposits contributes to SoFi's unique moat. And much of this clip that you're going to see next focuses both on the lending segment of things with the bank charter, but it also focuses on SoFi's moat in financial services in general, and more importantly, how these factors play together with reference to that direct deposit contribution and the diversity of product offerings that contributes to SoFi's moat.
With regards to the bank charter, what are reasonable expectations one should have for 2023?
We've made a lot of big strategic choices and bets, and the bank license was a highly debated topic and one that was really challenging to get our board comfortable with, and then even more challenging to get through the process with the Federal Reserve and OCC. In fact, I wouldn't be surprised if we don't see another bank license given out for another decade, especially on the back of some of the financial troubles we're seeing in the marketplace today. So it's an incredibly valuable asset. I couldn't be happier that we made the decision. It gives us a huge competitive advantage. It gives us lower cost of funding. It gives us the ability to use our deposits to fund our loans and not be dependent on others for their resources. In addition to that, we can really differentiate our checking savings account. We've come out with an interest rate that's really unmatched in checking of 2.5%. We have 3% on savings. It comes with no fees, 2-day early paycheck, the ability to pay any way you want. You can pay with your phone. You can pay with your debit card. You can pay person-to-person payments. We can do electronic pay. We can even send a check for you. In addition to that, it's all on your phone and easily integrated with our other products. In one click, you could be buying stocks or ETFs off of that platform. You can now set up auto investing off of your direct deposit account. And so it's the center of what we're doing for our members. It's the primary account. And it's also driving significant growth in high quality members. You only get the benefits that I mentioned if you do direct deposit with us. Our deposits totaled $5 billion prior prior to the bank, we had $1 billion. So we've driven $4 billion of incremental deposits just since opening the bank earlier this year. 80% of those deposits come from direct deposit customers. They're sticky customers. They're primary customers. We get to see the data on them. We can see if they have a mortgage that can be refinanced, if they have student loans or credit cards that could be consolidated into a personal loan. We can see if they're overrunning their budget, need to talk to a certified financial planner, or if they're sitting on a bunch of cash that should be invested to be compounding. It's also a good revenue product because when they do direct deposit, they spend it with their debit card, and our annualized spending now is in the billions of dollars, many billions of dollars, and growing quite fast. So the bank charter really solidified our strategy to then generate cross-buying from there and driving more products per person as well.
What keeps that deposit growth going? The strong APY helps. What I'm asking is, what's the differentiator?
Yeah, we try to differentiate.
As simple as that?
Yeah, we try to differentiate each one of our products on 5 things. First is fast, the fastest place to apply, the fastest place to move money. Second thing is selection. What does that mean? That means, what are the features and functionalities added on top of that? The interest rate is part of selection. The ability to have joint accounts, custodial accounts, the ability to do bill pay, ability to do person-to-person payments, pay with your debit card or with your phone, wire transfer, remittance, et cetera. That's all part of selection. The convenience element often is not appreciated because people think it's just about having it at your fingertips. But it's also, how convenient is it to use that checking and savings account with your SoFi brokerage account, or paying your loan, or applying for a new product. We're constantly working on those things, but it's also making it super convenient when you have a question or when you call in, having that person answer all your questions, not just about SoFi checking or savings. With SoFi checking and savings, we give you reward points. Those reward points are redeemable into any of our other products. So the product itself sits in an ecosystem that makes it more valuable as part of the ecosystem in addition to itself. I don't believe anyone can compete with us on rate. We're not even close to the highest rate we could offer and still be better off than our other choices. So I feel like we have a huge competitive advantage that will be hard for others to match, including the big banks who do not offer interest rate on checking.
Yeah.
That's significant. It's like 10, 20 basis points.
Makes a difference. I know people on my team who have switched.
And finally, moving down the list to the technology platform, I found a lot of insights with regards to Galileo and Technisys, where Anthony Noto basically explained that long-term vision of the AWS of finance, which we've talked about on this channel. We've also mentioned in the SoFi Weekly podcast, which I highly suggest that you tune into next Friday. And when talking about the technology platform, he mainly talked about how Galileo and Technisys have driven innovation in the company and how this innovation helps SoFi establish market dominance.
Moving to the technology segment, if you could kind of talk about the vision of that, sort of, we put Galileo with Technisys together. You talked in the more recent call about the B2B opportunity. A year from now, 3 years from now, how does that product look?
Galileo has gone through a huge investment. It's modern in the cloud. 99% of the authorizations we have are being processed in the cloud. And that is a Herculean goal that the team achieved with no small feat. We've maintained great SLAs for our partners during that whole transition of moving from on-prem into the cloud. We're deploying code faster. We have a great pipeline. I couldn't be happier with the technology, stability, robustness, redundancy, and pace of innovation we have in the business right now. I think it's second to none from a technology standpoint. We're running over our competition, whether it's incumbent processors or new modern self-proclaimed in the cloud processors. We're really taking share across this consumer segment and the B2B segment, and I expect us with Technisys to be very differentiated and continue to win big relationships. There are incumbents that have relationships with older technologies. It's not a question of whether our technology is better or a lower cost solution. It's a question of when they're willing to make the change from an older technology that's siloed. So we're in discussions with large banks that we've never been in discussions with before because we have a complete end-to-end solution. I think we're in the pole position to win those big financial institution, big bank deals, but it really is going to come down to when they decide to make the transition. We're also in discussion with large consumer companies that want to be in the financial services sector, that have big installed bases, that have partnerships that are pretty fragmented, that could be consolidated with Galileo and with Technisys. I think we're in a really strong position. LATAM, Technisys has done a phenomenal job with traditional financial institutions, and now Galileo's in those discussions. And in the US, Galileo's partners are in discussions with Technisys.
And in this segment, he mentioned a key insight, saying that SoFi is actually in talks with big banks and large consumer companies, which were powered by Galileo, and that they are in the lead to win much of that business. So this is absolutely massive, and it's something that many people might have missed, because if SoFi is in talks with the biggest banks in the world, if they're in talks with some of the biggest consumer companies in the world, it validates that AWS of Finance perspective powered by Galileo and Technisys, because Galileo and Technisys are really going to be spearheading, they're going to be the engine driving a lot of this change. Now, the host does push back on the costs related to the Galileo and Technisys acquisitions, the risk involved, and to this, Anthony Noto basically replies by sharing some of the details around the businesses that Galileo is partnering with. He talks about the partnership with MasterCard in particular and the pipeline of diverse partnerships out there.
There is a sense that there was a lot of overinvestment that went in. Many of your clients went after the same end client base. How are you thinking of that? Is that sort of a risk, or are there components where you can kind of say to particular clients, I can help you?
Yeah, I would say the financial stability of our top customers is pretty strong. I do think there will be entities that will have to pull back, but the sort of vast majority of our biggest customers are in really good shape. And those that aren't, we think we can replace with new customers or new products. The dimensions of growth for us at Galileo are the existing partners' growth in accounts. In addition to that growth, it's us selling in new products against that installed base, which is quite promising. In addition to adding entirely new customers, not just in the consumer segment, but also in the business segment. And last quarter, we announced almost half of our new partners were B2B. Many of the B2B partners have installed bases, so the time to revenue is very short, just a matter of integration. And we see more and more businesses coming to us as their awareness of the platform that we provide increases.
Right.
And we have a pretty big, robust pipeline with Galileo and Technisys. In fact, the first product that we'll launch that was built on Galileo and Technisys is Pay in 4. It's a partnership with MasterCard. It'll launch on SoFi first. We'll pre-approve you for a line. Let's say it's $500. We'll give you a virtual card. You can use that virtual card as much as you want. And every time that you use it, that amount that you're financing with that card is paid off in 4 payments, 1 at the beginning and then 3 subsequent payments. And that's a product that we'll launch at SoFi. It's a great additional credit product for our members. We'll only offer it to direct deposit customers again, so we'll have great information about them. But we'll also offer that to all of Galileo's partners. And it's a much better product for Galileo's partners than SpotMe or overdraft. The consumer's actually not paying an interest rate. The merchant's paying a percentage point that the company is getting. They are clearly taking credit risk, and they decide how much to underwrite, whether it's $100 or $500 or $1,000. It's knowable, especially for the direct deposit customer. So we think it's a really good offering that will drive incremental revenue for us. There's a clear opportunity for SoFi to do what it's doing consumer for businesses. So someday we'd like to offer small, medium businesses a checking account, a savings account, treasury account, ability to borrow money from us, the ability to invest with us, all the things that small, medium businesses need. All the technology that we're building is technology that can be used for small, medium business. We have such a huge opportunity in consumer. We're focused on that today, but we will plant seeds in 2023 that will grow in 24, 25, and 26 to add on to the growth rate that we have. And small, medium business is absolutely one area we'll go into, but we need to continue to show the regulators how well we can do in consumer before we ask for the permission to add other products like SMB lending and SMB checking and savings. There's a lot of demand for it. We get requests every day.
Finally, another interesting insight that many people might have missed is with regards to the vertical integration around moving checking and savings into that Technisys core. We've talked about SoFi's banking cores in depth in previous videos and also in the SoFi Weekly podcast. So it's really interesting, at least for me, that they're planning to move checking and savings into that Technisys core.
Just going back to the Technisys question, you had sort of multi-year, multi-level synergies that were promised. Where do you stand with regards to, are you on track? What needs to be done?
Yeah, we still believe the synergies we've laid out are all achievable. We're to the point now where go-to-market on both Technisys and Galileo and them together is being executed, and the feedback that we're getting from our partners is quite positive. A big piece of the synergies is also moving checking and savings onto Technisys' core off of the current core, and I'm excited about that, in addition to the credit card processing and the core onto Technisys. So some of the cost savings is just us bringing it in-house, which will be phenomenal once it's done.
As I said before, this is just me highlighting the clips that I found the most interesting. There's a lot of insight in that full conference. I think it's about an hour long. Definitely check that out if you want to learn more. But that concludes our video. If you enjoyed it, please share it out. And if you want to see more, please subscribe to the channel for more. For right now, this is the Fundamentals Investing Podcast. Thank you so much for listening.